Now, earnings season does bring volatility, which means you could buy some high quality companies at potentially attractive prices, and that is what we're seeing today. Waste Management reported yesterday after the market close, where they missed slightly 1% on earnings per share, likewise on the revenue. And what that's ultimately meant is that in the pre-market, they are in fact down. They were down also yesterday around 3 to 4%, so a slight recovery. Question is, trading near its 52-week low for a high-quality company, is Waste Management now a buy? Something we are going to cover in the episode today. We'll also run through our updated valuation. Now look, over the last year, with the drop today, it's pretty much going to be flat. Year to date, likewise, not the greatest performance, but over the last 10 years, this one is up more than 300%, which is very strong. That is an outperformance of the S&P, as we'll come to show you, and Wall Street do give this a buy, 4 out of 5. Seeking alpha on the weaker end at 3.5, which is pretty much the bare minimum just to flip into that rating. And when we look at the forward valuation, whilst it sits at 27, when the market opens, this will in fact be around 26, so it will be slightly below the 5-year average of 28, indicating a potential undervaluation signal. Just bear in mind, in 2021 and 2023, this one, the lowest point of the forward valuation, was in the 23-24 region. And when we look at the blue tunnel, which as always for new viewers does highlight the intrinsic or fair value, we can see it does sit towards the lower end. Again, when the market opens, it will be right at the bottom, and if it does slip below $200, that is where we will get the undervaluation signal. Although worth flagging that over the last year, this one has very consistently traded in a reasonable range. And when we do zoom out to the last 10 years, this one in fact has never once stepped out into a severe undervaluation signal. It either trades in a reasonable range or in fact trades at a premium, and that is where notably for quite some time it does sit above even the upper end. So what we will say here is, if we do look at just the last year, if we see it slip below $200, this in fact will be the first time Waste Management does look clearly undervalued. So maybe if we see it even just around the $200 range, one to seriously consider if you do have this on your watch list. Now, as a valuation grade, they do get a D, ultimately because their forward P is quite high above the sector. You're paying a 34% premium against their own 5-year average. As we said, when the markets open, it will be around the 26 region, so at a bit of a discount. And price to earnings growth, one we do like to incorporate, below 2 is, as we say, gets us excited. 2.6, although this will come down to around 2.3 at market open, is still regardless on both accounts above the sector, so you are paying a premium. But just look at their 5-year average at 2.8. This is a company that does typically trade at a premium. 2.8, as we said, when the market opens, it will be lower, meaning you will be getting a double-digit discount to their historical average. And also worth flagging, when we look at the S&P overall, it is very rare to see companies sitting clearly below 2, although we do have a few notable names that pop out. Nvidia 1.5, Alphabet 1.9, and Amazon at 1.8. And heading back to their earnings, we can see their revenue was up 15% from the same quarter last year. Great to see. Earnings per share, although it was just a slight miss, regardless, we only notice a 1% increase year on year. But one thing is certain, as we will come to show you, the numbers continue to move upwards, both on a revenue as well as an earnings per share. And worth flagging, something we always like to note, not only do companies increase their revenue, which is what we saw from Waste Management, but also efficiencies. Even though it is very small, nonetheless, margins were up 10 basis points. But one thing we want to draw your eyes to is the full year guidance. Some slight changes. What they've done for revenue is in fact a slight lowering. They've affirmed the EBITDA, slight increase to the EBIT margin, and they have kept the free cash flow consistent. And this is what will be driving our discounted cash flow model, which we will input $2.85 billion into 2025. So a miss in that latest quarter, as we can note, and over the last 4, in fact, they've missed 2 of them, so a 50% track record. If you have faith they can in fact hit those targets for the next 4 quarters, then their estimated double-digit earnings per share growth. And in fact, if we look towards December next year, if they hit that EPS of 850, then the forward P does lower even more to 25.2, which is a fairly rare occasion for Waste Management. Now, it is one that the institutions themselves do like quite a lot. They've got 80% ownership, and whilst they've sold 6.7 billion worth of shares in the last year, they bought twice as much at 12.6 billion. Just look in the most recent quarter though, they bought 4 times more than they did in fact sell. So they are very bullish, not just over the last year, but also in the most recent quarter. And if you wanted to go back to a time where in fact they sold more shares than they did in fact buy, you'd have to go to Q4 2022, clearly highlighting Waste Management is a very, very strong favourite of the institutions overall. And it's not only institutions. When we take a look at the Bill and Melinda Gates Foundation Trust, this is in fact their third largest stock, holding around 15.5%. Now, if we just take a look at the underlying metrics, because we have said this is a high quality company, well, they increased their dividend last year by 10%, over the last 5 years 8%, over the last 10 on average 7.2%. Not only that, but they've been increasing those dividends for the last 21 years on a consecutive basis. If they do it for another 4 years, they will become a dividend aristocrat. And we'll also point out that the dividend does look to be safe with an 80 score. Yield is on the more trivial side at 1.5, but still nice to know that it can be covered. And we'll also just flag that confirmation when we look at the free cash flow payout. Now, when we do look at these metrics, you can also see the earnings data, not one we do look at because it is susceptible to manipulation by management through accounting. So on the free cash flow payout, we want below 60% for management to give us faith they can continue to offer some nice dividend increases, and over the last 10 years pretty consistently below the 60% rate on a trailing 12 month at 59, over the next year expected to lower at 44, so no worries whatsoever. We did just see an 80 safe score. Free cash flow, as always, per share, we want it to continue to climb, consistency over the longer term. Not massive in terms of the growth, but if we look at it from a standpoint of 2015 to 2024, we see it has nearly doubled. Massive growth anticipated just in the next 12 months. Then we move on to the sales growth. Double digit, in fact, on a trailing 12 month, but the story is over the last 10 years, it is fairly inconsistent. Now look, at a bare minimum, what we want with revenue growth is to keep up in line with inflation. So if we're not seeing it at a bare minimum of 4% like 2023, then in real terms, top line is decreasing. Now, we will cover their total sales in a little bit, but you can see it's gone from 13 billion, nearly doubled, to 2024-22. But what we want to drag out here is shares outstanding. Yes, this is a company that does pay dividends, but also returns excess cash to investor pockets through share buybacks, and what they've done over the last 10 years is buy back 10% of those shares, which is great to see, and maybe one we will see continue over the next 10. Another nice added bonus on top of those dividends. Now, ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital, and that is what we get over the period. Very consistent, 9% in 2024, 10% sitting on a trailing 12-month basis. And then we move into the margins. As always, we don't just want companies that increase their top line, but we want to see efficiencies, and that is what we get on the operating side, well above the minimum 12%, sitting at 16 in 2015 and continuing to climb 20 in 24. Little bit of a drop though on a trailing 12-month basis. Free cash flow pretty consistently above the minimum 5%, sitting at 9 on a trailing 12-month. And the final metric that we do like, as importantly as the ROIC, is the net debt to EBITDA. Now, this does correlate to balance sheet strength and dividend safety. Below 3 is what we want to note here, and the numbers you see are the number of years it would take Waste Management to pay off all of their debt net of cash on hand. Now, it has increased in 2024 at 3.6. Great to see the drop on a trailing 12 month, and nice to note management expect this to go even further below 3 over the next 12. Something we would say just to keep an eye on, but the trend does look to be going down. We then move on to the growth, which comes to a C. Now, revenue year on year is up 14%. They're expecting 9 to 10 this year, which on both accounts is above the sector median. Also, they're growing their revenue faster than they have done over the last 5 years, which is a great sign to see. And earnings per share projected over the next 3 to 5 years to grow 11% year on year. That is pretty much in line with both sector as well as their historical, and it does get to see ultimately as an investor, if you're paying a premium to the sector overall, you would like to see growth looking a little bit stronger. And likewise, if we look at profitability, which comes at an A+, gross margin 40%, well above the sector at 31%, slight improvement to their 5-year, great to see. And bottom line net income 11.4, well above the sector at 6, and a very, very slight improvement to their 5-year average. What does look to be very strong though is the cash they generate from operations, 5.6 billion, well above historical 4.5. And we also like to compare their performance against others in the sector. We have Waste Connections, Republic Services, as well as a few well-known others. Now, if we look over the last year, Waste Management is up only 4%. With the drop we should see when the market opens, it will likely be flat, which tells us it is one of the worst performing. But actually, this industry as a whole, for the most part, hasn't been the best in the last 12 months. When we do zoom out to the last 5 years, is up 109%, which is pretty decent, and we can see it right there in third place. So there are some that have performed better, but also others in the industry that haven't had the greatest period. And stretching it out one more time, very strong 375%, but two other popular ones in the same industry have in fact performed a lot better. WCN up 490, RSG up nearly 500. Doesn't mean this will be the trend continuing, as past performance isn't an indicator of the future, but just one to take a note of. Maybe also in another episode we can uncover these two others. The other thing to note is how has it performed against the S&P 500. Now we've also chucked in the QQQ, so you can also take a look. But in terms of the performance, they're up 4% in the last year. S&P as well as the QQQ have massively outperformed. When we zoom out to the last 5 years, we can see Waste Management very minimal outperformance to the S&P. QQQ has outperformed, although fairly slightly in comparison. And over the last 10 years, that is where we see the disparity. Waste Management has massively outperformed the S&P, but actually the QQQ has massively outperformed Waste Management. Now the thing to consider here is if you're investing in individual stocks, you always want them to outperform something like the S&P. Otherwise, you just invest in a low-cost ETF like VO. So you need to have that faith that Waste Management can continue their very strong run. Let us know if you believe that will happen over the next 5 to 10 years. And if we have a quick look at their income statement and balance sheet, we'll see their revenue over the last 10 years has been very strong. As we said earlier, it's nearly doubled from 13 billion 10 years ago to now sitting at 22. But the question isn't their revenue, it's their bottom line net income. Do we get the continuation of growth year on year? Does the trend follow the top line? And the answer is yes, it does. In fact, it reported $753 million 10 years ago, now sitting just under 3 billion. So that is great to see. We like it when revenue and bottom line do match. That is something that maybe you think is very common, but that isn't what we see. And the other thing is a quick health check, total cash versus total debt. Now they had 39 million 10 years ago on the balance sheet. Now they hold around 440 million. But in isolation, one number here doesn't give anything away. So we compare it to their total debt numerically and directionally. So their total debt has actually been increasing over the last 10 years, just under 9 billion 10 years ago, now sitting at 24, and that is why on the net debt to EBITDA, it was sitting around the 3 mark. So definitely something we would say just to keep an eye on. And before we move into the valuation, just to let you know, we have released our latest free weekly article. We drop one every single Sunday morning to your inbox, covering severely undervalued stocks, as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month, November's copy dropping in a few days, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now our updated valuation comes to $221 derived on these three models. We'll run through each one very briefly, talking about the inputs. First one is the multiples valuation model. Companies in a similar sector and size that we just highlighted, their average P multiplied by the EPS for Waste Management coming to just under $250, our first undervaluation signal. Bear in mind though, we don't look at any one of these models in pure isolation. And then we have the dividend discount model with the average growth around 9% in the last few years. We've gone a lot more conservative at 6.5, and we can see our second undervaluation signal. Now the third model is the DCF, which you can either look at this in pure isolation, or in fact you can use it like we do for today's episode as an average of the three. But if we just talk about this, the average growth is 7% over the last 10 years, just in the more recent year sitting at 18%. And what we've done for 2025, as we highlighted earlier, is we've used management's projections for that year. Now the main thing to take away is, if you're just looking at this model in isolation, based on a reverse DCF, 13.8% growth is already factored in at the price of around 206. If you see that as too high, you may look at this company as overvalued, too low, potential undervaluation. Now we have three rates as always, 8, 12, 16. Numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Waste Management or any others. But using the middle rate of 12% and the discount rate of 8, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, getting to $178, which does actually solely on this model indicate downside of 14. For transparency, we'll show you at 8%, 126, downside of 39, and for those a lot more optimistic, at 16, 244, 18%. Now today's episode, we are using the middle rate in combination with the other three, which gets to $221. Now remember, on the channel, we like to kick things off with a 10% margin of safety, execute buy if it meets our three golden criteria: wide moat, strong financial metrics, good forward-looking data, which would mean a buy around $200, which is where we said earlier in the episode it would slip into the undervalued signal. Now what this highlights today, if you're buying at 206, there is 7% already factored in terms of an MOS, and Wall Street themselves see this at 255 into next year, translating to 24% upside. So let us know your views on Waste Management, whether it's a buy, hold, or complete avoid. At a 10% MOS, as we said, a buy around $200. At 20, a buy at 177, and at 25, 166. And we can end the episode by highlighting Waste Connections, another company in this industry. This one forward PE does sit at 31.7, below the 5-year average of 35, and also, like Waste Management, is trading right there towards the bottom end of the blue tunnel. As always, let us know your views on Waste Management today, where you see this in terms of the buy, hold or sell. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.